Appreciation versus cash flow in multifamily. Hey everyone, welcome to another video. Today we're talking about appreciation markets versus cash flow markets, specifically when talking about multifamily apartment buildings. So what do we mean? Doesn't every apartment building appreciate? Doesn't every apartment building cash flow? Well, some do, some don't, but typically it's a function of the market you're in. So, for instance, I'm in Miami, it's a heavy appreciation market, tough to find deals that cash flow from day one. If you go to a secondary city or tertiary city, maybe near a suburban or rural area, you might more likely going to find some cash flowing properties that cash flow from day one, but may not necessarily appreciate in the long term. So obviously we want to get properties that both appreciate and cash flow, but generally markets will be thrown into either an appreciation category or a cash flow category. And if you go across the country, it's a question I like to ask to other investors is, oh, is this an appreciation market or a cash flow market? And usually people will know what that means. So, I'm going to run through here exactly what an appreciation market is versus a cash flow market, starting with appreciation. So, what are some of the characteristics of an appreciation market? You're going to get negligible or no entry cash flow. Keyword there is entry cash flow. So, when you buy it, you're typically not going to get much, if any, cash flow from the property. That means after all you've collected your rent, you've paid out expenses, and you've paid out your debt servicing, assuming you've got a loan on the property, you're probably going to be at zero, maybe even negative at the start, cash flow wise. And the reason being is that you buy these in these appreciation markets at such low cap rates that they don't make enough money at the start to generate enough cash flow. So where do you make money then? If you're not cash flowing, where do you make money? You're typically making money at a refinance or sale. So the way I like to break it down is look at a 5-year hold period. Say you're going to buy it on day one and you're going to sell at year 5. Where is the money made in between in a deal? With an appreciation market, so this could be New York as well or somewhere in California, you're renting out the units, you end up making very little cash flow because while rents are high, the prices of properties are also very high. But when you refinance or sell the property, you're typically going to make a much larger jump in value than you would in a cash flow multifamily market. So higher multiples on any NOI increases. So effectively that means that you're getting a 20, 25, maybe even a 30x multiple on every dollar of NOI increase. So if rent goes up $1, you might get a 20 or 25x valuation on that dollar. Now, appreciation markets, you have to read your investors as well. If you're bringing in capital, a lot of investors may not like investing in an appreciation market or an appreciation property. And that's because they're not going to get monthly or quarterly checks in the mail for their investment. A lot of investors like to see that. Usually when you get to the higher end investor, maybe a very high net worth individual, definitely institutions, private family offices, they're okay not seeing monthly and quarterly distributions. They're more interested in what's the overall return of their investment. So they're okay getting a big check at the end or in year 3 at refinance. But for some people, that cash flow is part of their reason for investing in real estate. And it's not going to occur in an appreciation market, at least not at the start. Maybe 6 months or a year in, you've increased rents or you've done some renovations and you can get some positive cash flow, but it's generally not the reason you're investing in an appreciation property in an appreciation market. So that's it. We'll look at cash flow markets now, and it's virtually the exact opposite of an appreciation market. You're cash flowing from day one. Hopefully, you've bought a property at a good price, and you've got some spread there on the cap rate versus the interest rate. So you're getting that stronger cash flow coming in, and this does lend itself well to those investors we talked about earlier that are looking for that mailbox money, that cash distribution monthly or quarterly. So you're getting that cash flow. But obviously, there's got to be some drawbacks on it. You're making your returns solely from rents, unlike the end when you sell it or refinance. But you're getting little to no net appreciation. Now, I've capitalized the letter N there for net. And why I did that is because you're getting, if you calculate, you might say, hey, I bought this property for $3 million and I'm now selling it for four, a few years later, great. But if you actually look at the adjusted appreciation, and by adjusted, we're talking about, hey, take out inflation from this part of the equation, and then also add in the capex that you've had to put into this property. You're going to see in heavily cash flowing properties, typically they don't appreciate over time, or if they do, it's very little. So the point of buying it is you're just taking the cash flows out of the property, trying to keep expenses low, trying to keep capex to a minimum. But overall, you're not truly appreciating. Even if on paper it says it appreciates, it's really not appreciating, and you're really only taking most of the returns from the rent you collect. In an appreciation market, it's the exact opposite. You're pretty much taking limited or no cash flow rent, but it is appreciating over time a lot stronger, and that's where you take your returns from. Now, what's better? Of course, it really depends on what you're comfortable with and where your capital is coming from and what they're looking for. I will say over time, typically an appreciation play will make more money. However, a cash flow play is taking money more consistently in the short term. And sometimes having money in your pocket is a good thing, gives you other options, makes your balance sheet look a lot prettier. An appreciation market, of course, the appreciation play has to actually work out. So if you've bought a property, assuming that it's going to appreciate because of the area it's in, because it's a nice and newer property, and it doesn't, then you're not getting any, you're not going to get any returns on that refinance or sale, or it's going to be minimal, and you would have been better off going to a cash flowing property. So ideally, you're getting for entry level investors, you're getting deals that have some cash flow, but also appreciation potential. But if you go to the extremes, either a rural area in a tertiary market for cash flow, or you go to a hot Class A market where you're going to be mostly appreciation. You're going to see these extremes. And at first, when I started investing, I was always asking myself, who is investing in these 3.5 cap rate buildings? How are they making any money? And the answer is that they're making money in the refinance or the sale of the property. The cash flow is secondary. And when you get into apartments, you assume that cash flow is everything, but really there's multiple ways to skin a cat in multifamily. And these are the two, dividing lines, for lack of a better term, in multifamily of how to make money. So that's all we have for today. Thank you for tuning in, and we'll see you next week.